Well, good afternoon, all of you. I hope you're not freezing. On this side of the room, we are. So please stay with us. We'll try to warm up the atmosphere in the next few minutes. Well, as we are all aware, we live in interesting times in all kinds of dimensions. Two dimensions I would mention to start with. First, I think it's fair to say that uncertainty has risen in the world economy for a number of reasons, including the political shocks that were alluded to previously. This has increased volatility on a number of markets, and this part of the world certainly has been very affected, but it's also true of the euro area, if you look at the interest rates, for instance. First factor. Second factor, we all need more growth. I mean, it's not particularly original, but we are in a situation where growth in Singapore has slowed down. So a number of steps have been taken, including monetary policy step in April and reconfirmed in October. And in the euro area, as you know, we are exiting from a period of very low growth. Unemployment is still very high. And we have a number of issues to deal with, including, I think, for all our economies, inclusiveness, as was said previously, to be able to undertake policies that promote inclusiveness. Obviously, you need sufficient resources, hence growth. So we are in an interesting period where policymakers have to ask themselves what's the best contribution they can make to help either relaunch growth or at least sustain growth in the next few quarters. This afternoon we will have a panel to discuss this question, which is composed both of members from the euro area, they both happen to be French, and from friends from Singapore. So I would like us to address the issue from both areas, of course, perspective, both from an official sector's point of view, and we will have with us Anne Le Laurier, who is first Deputy Governor of Banque de France. Anne has had a very active life in the Ministry of Finance to start with, then moving to manufacturing sector, electricity sector in particular, and then back to the public sector in Banque de France. Yeah, not that EDF was very private, but 15% is private. On the Singapore side, from the official sector, we have with us Edward Robinson. So Edward is Chief Economist of the Monetary Authority of Singapore and Vice Chairman of the Economic Policy Group. That's right? Assistant Managing Director. Okay, of the group. So these two speakers will provide the public sector point of view, and then we will turn to Philippe Heim, who is CFO from Société Générale, also a former member of the French Ministry of Finance. That makes three of us here this afternoon, and then to Manu Baskaran, who will offer his views on what's the contribution of monetary policy, but also of other economic policies, in particular in Singapore. So with this, I would like first to welcome Anne, who is our first speaker and has a few slides.
Good afternoon to all. It's a real pleasure to be back in Singapore. So I'm asked to answer the question, can monetary policy help relaunch economic growth? The answer is yes. Guess you'll be frustrated if I end up here. So just three main points for a start. The main contribution of monetary policy is to provide for price stability. In our case, i.e. in the euro system, our target is to bring inflation close to but below 2% over the medium term. So we are one of many central banks having inflation targeting. Maybe even if it could be a bit odd at the present juncture, it's worth recalling that inflation targeting is meant both to avoid deflation as well as inflation. We tend to have short memories, but we should remember that inflation is a big driver of inequalities at a time where there's so much discussion of inequalities. And we should not underestimate the fact that our fellow citizens strongly dislike inflation. So even if inflation is not around the corner, inflation targeting keeps its double meaning, against deflation, but against inflation as well. Second point is that monetary policy, at least in the Eurozone, but elsewhere too, has been very instrumental in alleviating the negative effects on potential growth of the global financial crisis. And if I remember correctly, just after 2009, central banks were seen more or less as saviors. Nowadays, they are criticized a lot because people have realized they have no magic wand. But we'll come back to that. It means that we need other policies to accompany monetary policy. And the last point, perhaps, which is also very important right now, is that monetary policy can help support structural reforms by compensating for any short-run negative effect they may have on demand, of course. So let me elaborate a bit along these lines. First of all, I would argue that the ECB accommodative monetary policy has contributed decisively to the ongoing recovery. Second, it's true that our monetary measures do have side effects and that complicate the transmission to growth and to inflation ultimately. And third, that we haven't exhausted our means. So first point, we are in a situation where monetary policy has contributed decisively to the ongoing recovery. I'm not sure I've taken the right comment for the slides. Maybe it's the box here. I'm sorry. So the first slide is just for you who are not too familiar with it, is a list of all the measures which have been taken by the European Central Bank. And you see there is a concentration in 2014 of a lot of complementary measures. A negative deposit facility rate, targeted long-term refinancing operations, a cut in policy rate, the launch of a purchasing program of assets. So that is the activity, if I may say so, which started in 2014. So far, we have provided excess liquidity of over 1 trillion euro. The deposit facility rate, which is the de facto policy rate for the market, is set at minus 0.4%. And we've indicated we do not intend to go lower. And we have a commitment to the future price of interest rates, i.e. we have a forward guidance to which we intend to stick. And the purpose of it is, of course, to influence longer-term rates, which are largely determined, as you know, by short-term rates, or at least expectation of future short-term rates. So what is the purpose of all these measures? It's pretty simple. Low rates are meant to bring forward demand. The ECB balance sheet channel, i.e. the ECB balance sheet size, reinforce the signaling of accommodative monetary policy. As you know, central banks don't downsize their balance sheet very quickly. The credit expansion channel lowers the effective cost and improves the availability of credit to the non-financial private sector. And finally, there is the portfolio effect of rebalancing between assets, which is directly linked to the asset purchase program. Now, of course, we don't have a counterfactual. What would have happened if we had not done that? So we did a lot of work at the Eurosystem level to using a variety of models to try to estimate our impact, both on growth and inflation. Of course, it's not rocket science. I'm not going to give you hard figures, but our estimate is that all these measures have had an effect on average annual inflation of around 0.5% over 2015 to 2018, and a cumulative effect on economic growth of the euro area of about 1.6% by 2018, i.e. over the 4 years. The second point, of course, is to acknowledge that our measures have side effects that complicate the transmission to growth and inflation. First of all, I'm sure Philippe will be eloquent on that aspect, but I will not agree with him on everything. Low interest rates tend to squeeze net interest rate margin of banks and hence have a negative impact on their profitability. However, it also boosts a greater flow of lending, allow for lower loan loss provisions than would have occurred in the absence of this accommodative monetary policy. And finally, we support the provision of long-term financing to banks via the TLTRO program. And all that has led to a continued and solid credit growth in the euro area. You see that on the right-hand graph. You see that we picked up since 2014 quite substantially on the growth rate of lending to non-financial corporates. And on the left-hand side, you see that the interest rates charged to corporates have also decreased a lot. So on the issue of bank profitability, so far, our estimate is it's an overall positive. And if you're curious about how we arrive at that conclusion, I can refer you to the website of the ECB, where you'll find a detailed discussion of that aspect in the latest financial stability review. The second side effect, or potential side effect, has to do with inequalities. Because, of course, you know, there is this debate ongoing about the distributional effect of monetary policy and whether it's increasing or worsening inequalities. So here again, we've done some work thanks to a detailed review of household finance in the euro area. And even though you can argue that in principle, low interest rate and asset purchases benefit the wealthy, and they benefit the wealthy, so they have a very low impact on the propensity to consume. But in fact, over the medium term, the most important point is that by increasing employment, by increasing growth and hence employment, we in fact contribute to lesser inequalities. But back to the short term, there is a tendency to overlook that households are not all creditors. A lot of them are net borrowers. And in fact, this kind of accommodative monetary policy slightly improve their net income. Then if you dig into quartiles, of course, you'll have different impact, whether you're in the lower quartile or the higher quartile. But overall, the distributional effect in the short run are very little given this indebtedness of households. The other thing, of course, is the wealth effects, but the wealth effects are benefiting from home ownership, which is pretty widespread in the euro area, with a notable exception, which is Germany, where renting is more important than home ownership. But otherwise, home ownership, including for young, lower income households, is beneficial. The third point is to argue that we haven't reached our limit. So that is true, I would say, globally. On the other hand, some of our instruments have limits. You're familiar with the effective lower bound on nominal interest rates. We cannot buy more assets than there are. That's a physical limitation. But the truth is that there is no limit on the amount of money that the central bank can create. So we are not at the end. If need be, we could do more. But the most important point is that even if we can do more, we cannot be the only game in town. And allow me to remind everyone that this has been our motto for more than 2 years. So it's not a discovery of 2016, at least from the part of central banks, that monetary policy has to be supported by fiscal policy and structural reforms. And we very much hope that this message is going to be listened to. It seems it's beginning to be listened to a bit on fiscal policy, but it's still very much in need of being heard in the area of structural reforms, where governments are a bit lagging, if I may. So we hope that these structural reforms will proceed. We have a very good textbook example in the euro area, which is Spain. Spain has done its homework and has done a lot of structural reforms, and they have one of the strongest growths nowadays in the euro area, doing much better than France in passing. So what can I say for now? Pretty much the same message which have been already conveyed by previous speakers. The new feature, I would say, of our environment is heightened uncertainties, and in particular political uncertainties. So we have had the immigration crisis, or we're still having the immigration crisis in Europe. We're having the aftermath of the Brexit referendum, the aftermath of the election in the US, and a bit of a question mark on future orientation in China next year after the Congress. But, why am I insisting on this specific feature of the present juncture? It's a very simple reason, is that beyond fiscal policy, beyond structural reforms, if corporates or households are very uncertain about their future income or about their future market, why would they invest? So I think bringing back confidence is absolutely key. I don't have any recipe for that. The only contribution we may have as central banks beyond monetary policy is having a steady hand and being clear about what we are doing and what we intend to do. So we may contribute to reduce uncertainties, but they go far beyond our reach. Perhaps the new thing today is that we had 2 scenarios for the future, which were not very encouraging. One was secular stagnation, the other one was slow normalization. We may have a third scenario, reflation by the US, but I understood from Professor Di Moro that we should not be too confident in that, so we'll see. And a few thoughts to conclude. Number one, may I ask you, absent monetary policy by central banks, where would be populism? I think that's an interesting question. The other interesting question is, what about central bank communication? I would like here to take an example. It's well known. It's the taper tantrum. Everyone has been very harsh with the Fed. And when you look at it in retrospect, it seems a bit unfair. Look at the communication by the FOMC in May 2013, then in September 2013. And then you wonder why a tantrum. And then you know that the tapering only began in December 2013. So the least we could say is that the Fed has been very cautious. Now the question is, how can we deliver an efficient communication? And this is a real challenge. To give one example, it's very hard to get market participants to pay less attention to timing and more attention to economic fundamentals. And this is true on the domestic side as well as on the international side. So rather than seeking the culprit on the side of the central banks, I would offer you could seek the culprit on the side of the markets. And here the reason is the markets always prevail, but that doesn't mean that they're right on the fundamentals, and they better concentrate on the fundamentals. Thank you.
Thank you, Anne. Edward?
Thank you. This topic for the panel, can monetary policy relaunch economic growth, has a long and illustrious history in macroeconomics. And indeed, I think one can argue that disagreements about the question, does money matter, has been the basis for the emergence of competing schools of macroeconomic thought through history. From a central banking perspective, I thought I would just very quickly classify the various schools of thought about expansionary monetary policy post-GFC into sort of two very simple camps. And then I'll go on to possibly argue, I think I have a slightly stronger strain than Deputy Governor's message just a minute ago. I will argue that while there's definitely a continuing role and an important role for monetary policy in the current conjuncture, the bulk of the unfinished business, at least in policy response and so forth, lies elsewhere outside of the monetary policy arena. So in terms of the two approaches that you can classify arguments, let me just call it as real and monetary. This is oversimplifying and generalizing. So the real camp, the argument is that the deterioration, it is the deterioration in the underlying economic fundamentals that have caused the growth malaise, the growth slowdown, the persistent growth slowdown that we are faced in. And the most obvious summary measure of that is the underlying fall in real interest rates in R star, as it's come to be known. And if you follow that argument, then all central banks that are doing now is just to accommodate that fall in R star, a reflection of the deterioration in our economic fundamentals. So you can look at estimates. Some of the earlier estimates, for example, came from Mervyn King, and then the IMF and BOE have sort of validated that the decline in real interest rates, or R star, was a phenomenon that predated the GFC. I mean, you do pick it up from the early 1990s, for example. And the underlying reasons for this, the correlates for this, are structural. So demographic, technological headwinds, an increased propensity to save, at the same time a reduced intensity of investment expenditure. Now the second camp, let's simply call it the monetary camp, follows from the older sort of school of monetary economics, which suggests that the process of credit creation in the economy is the one that generates effective purchasing power in the economy. So central banks can influence this degree of credit creation in the economy by adjusting the interest rates. And as we know, that the particular sort of metrics that we use is to bring your market interest rates way down, significantly down what is normally thought of as the natural level of the interest rates. Now, so as an econometrician by training, I do detect a problem of identification here between the real and monetary views. So the deep parameters underlying planned saving and planned investment ex ante are unobservable. And by definition, realized savings and realized investment are equal to each other. So you have a problem of structural factors driving the time-varying R star, and they're sort of bunched up with a whole bunch of other shocks, including cyclical as well. So how do we sort of resolve this? I mean, you look at it, the typical way that economists look at it is the short-term, the long-term the medium term and the long term. The long term, we know, I think we all will agree that one of the steadfast proposition in macroeconomics is that monetary neutrality holds, and let's just adopt this for the moment. In the short run, then where do we have? I mean, I totally agree with Deputy Governor that certainly the massive central bank purchases of assets and so forth was definitely needed and did succeed in stabilizing financial conditions and lowering, bringing down the required R below R star. I mean, we had all read Friedman and Schwartz, A Monetary History of the US 1963. And the important point was that we knew and we were able to use instruments available to us to forestall a descent into widespread liquidity seizure. So monetary policy was certainly not found wanting against a downturn in the short term. But as we go into the medium term and so forth, I think we do need to give due attention to the collateral effects of unconventional monetary policy and with it, the apparent diminishing returns. So for Singapore as a small open economy, for example, we have been quite concerned by the fact that QE, by causing large financial flows within the wholesale banking system or banking system across countries, has created new networks of cross-border linkages that could prove to be fleeting and unstable. Summers and Eggleston, for example, have also formalized the channel by which a secular stagnating country at the lower interest rate bound can export that condition across countries to the real exchange rate and capital flow movements. And here's the point, I think, where I might slightly place a slightly different emphasis than the previous speaker. I think the issue of diminishing returns to unconventional monetary policy comes in an argument that Mervyn King emphasized. Monetary policy works, as we all know, by bringing forward consumption. And I mean, there's a limit to which you can do that. Repeated monetary easing will soon exhaust all spending borrowed from the future. I think that's that effective constraint. If you don't have at the same time forces that are going to increase your level of permanent income in the economy. So if I can use an analogy here, we could be facing a similar problem to AMR, or antimicrobial resistance in pharmacology. So this is the real risk that drugs don't work anymore because bacteria mutate and develop stronger resistance against the available antibiotics. Incidentally, I might add that no new class of antibacterial drugs have been discovered for the past 20 years. In comparison, we central banks seem to have been a bit more creative in achieving instrument creep. Now, 8 years after the crisis, I definitely agree that monetary policy has a continuing role in securing growth. A fair degree of monetary stimulus, I think all central banks would agree, must remain in light of new uncertainties and the new risks that are coming on top of the already fairly measured momentum in growth and low inflation phenomena across a number of countries, including Singapore. So in Singapore, monetary policy has been eased progressively since January 2015, in line with weak underlying inflationary pressures. And we did take a sequence of measured steps to reduce the slope of the exchange rate policy band, which is now on a 0% appreciating path since April 2016. We did also, for the first time, signal that this neutral policy stance would possibly be needed in the absence of further shocks for an extended period to secure our objective of medium-term price stability. So where do we go from here now? I think in the same way that antibiotics do not work against a viral infection, we cannot expect monetary policy to solve all ills that face our economies. And the limitation, as I argued before, would become increasingly constrained as we move into the long run. Monetary policy cannot on its own quash all manner of uncertainty in the operating environment before us. nor can it stand alone against the potential virulent hindrances to global trade and the free movement of factors of production. Now, in this forum, I think it may not be amiss to draw on the views of Jean-Baptiste Say, the well-known distinguished French economist of the early classical macroeconomic school. And many of us in this room will be familiar with the very often quoted Say's law, the powerful proposition that supply creates its own demand. The law is suggesting that the production of output itself leads to the generation of purchasing power in the economy. Now, Say was, of course, writing in a very different environment that we find ourselves in. He was writing at the period of the Industrial Revolution, where there were much concerns over increased output. So the modern variation and the modern context is possibly the hoarding of money at zero interest rates and revival of the secular stagnation hypothesis. So my contention is that a fairly liberal applications of Say's law would suggest that we should not ignore the underpinnings of the long-term production capacities of our economy. Indeed, Say wrote that the aim of good government is to stimulate production. So that means factor market reform, investment in human and physical capital, strengthening market infrastructure, conduct, and so forth. And as a small open economy and a price taker in world markets, I think Singapore has found that advantages and found it of much value to take a supply-side perspective to our long-term development process. And this has meant taking a strategic view of the economy's evolving comparative advantage by providing the necessary incentives and targeted measures to facilitate the ongoing reconfiguration of industry, as well as the building of new capabilities that the DPM had talked about earlier. I think the importance of the real side of things, the domestic structural reform, is going to be even more critical if the expectation is that we need to contend with some degree of reduced intensity for longer, including due to the possible exogenous shock to impediments to trade. Thanks very much.
Thank you, Edward. We're now turning to private sector views. You can remain seated, Philippe, if you wish.
No, it's okay.
No, okay. Okay, so Philippe will share the view from...
yes, thank you very much. So, wanted to share with you after those two very interesting presentations, the very humble perspective of a banker. I am the CFO of Société Générale. You know, we are a bank operating in France, throughout Europe, to Russia and Africa. We have also the privilege to operate globally in markets. And the topic is indeed is very interesting. How is monetary policy helping to rebuild the growth? And straight away, and I will respond, yes, the impact is surely positive, but not without consequence on banks. And it will be a topic I wanted to, let's say, to illustrate. If we start by the beginning, maybe let's highlight, let's say, the instrumental role, the specificity of banks in economic environments. We are assigned by central banks, I would say, and if we analyze how we operate in the economy, three main functions. We are a key player in the transmission of monetary policy because basically what we do is we pass on monetary impulses to the real economy, and it is essential that this pass-through process is efficient. So when central bank decide to cut rates, it's very important that our clients have the benefit of that. We have a second very important role to play. We are, in a sense, a shock absorber, in the sense that we have to provide our clients, households, companies with liquidity. We have to help them to finance their investments, to finance their treasury, and to follow, I would say, a smooth path, protecting investment. And that's why we banks collectively, we play a critical role in the transmission of monetary policy. And then, of course, the last and foremost mission of a bank and the banking industry is to finance investment, to contribute to long-term macroeconomic performance. So this is our capacity in the long run to finance the economy. And that's why I would say a sound and healthy banking system is critical for any economy. And of course, this is something, a clear element of focus of any central bank. And clearly, first conclusion here, before appraising, let's say, the last effect of the unconventional monetary policy is that in the past 5 years, ECB responding clearly to this mandate and protecting, let's say, the stability of the European financial system. If we move on, let's take into consideration the fact that we are very specific in Europe and very different from the European financial system in the sense that we are, by essence, an intermediated economy. What does it mean? It means that 85% of the loan granted to households or to companies are held in our balance sheet. In the US, the system is completely different because all loans are packaged, securitized, and sent to the market. That's why we are, I would say, in the food chain, we are between central banks and the market. And of course, it's all the more important that we maintain in the long run the soundness of the banking industry. So how can we see the effect of the current monetary policy? And you have there to have in mind two different effects. The curve is not flat. Interest rates are negative at minus 40 basis points for overnight facilities. And then, after, let's say, a certain period of time, are completely flat. So, in fact, in our job of providing liquidity and granting loans to our clients, we are affected by two elements. First, on the cash we held, and we send to ECB or Banque de France every night. The part of the money not used to buy assets has to pay some kind of tax, a monetary tax of minus 40 basis points. But this is basically the intention of ECB because ECB wants us to use, to inject in the real economy our cash. But the point is that we may not necessarily have, let's say, in front of this cash capacity to reinvest. Then you know that the traditional job of a bank is to do what we call transformation. The fact that we reinvest on a long-term or medium-term basis the stable part of our deposit. And this activity, by essence, is critical, and this is, let's say, one key component of the revenue we get from interest rates. And today, I would say on those two elements, on the short-term part and on the medium-term part, two effects. The fact that today, an institution like Société Générale, end of June, I held something like 99 billion euros of cash available, posted to Banque de France, to ECB, to the Fed, to Bank of Japan. So on this part, I had to pay negative interest rate. And then, as the curve is completely flat, basically, we have a diminishing contribution of transformation. So if we step back one moment, what we see today in terms of impact on the banking industry in Europe. Clearly, to be fair, we see positive developments. First positive development is that we have stronger demand for loan, and basically it was the intention of ECB, and we have seen a positive development on that side. The financial burden on corporates and households has been lowered. So one, let's say, positive development is that the cost of risk has lowered in Europe, and this is a second positive element. And globally speaking, the ECB policy has managed to promote more resilient economic environments. On the flip side, and there we have to be, let's say, vigilant to some elements, the fact that so long this policy of flat curve will remain, of course, you will have a pressure on bank profitability. clearly. And today, the situation we have in Europe is that, globally speaking, I don't distinguish between jurisdiction, between institutions, but from a macroeconomic standpoint, the return on equity of European banks today stand at roughly 5%, while the cost of equity is at 10%. It is not a reflection of today's profitability. Today's profitability is fairly good, I would say, but the valuation you've got from the market reflects down the road the profitability the market expects you to deliver. And today, the market is pricing the fact that we are for long in this environment of flat curve. So, as a wrap-up, there is no doubt about it. The very bold and very inventive monetary policy of the past 5 years has been efficient. First, to sort, let's say, the financial crisis, the peak of the financial crisis we have into it. It was also very efficient to cure the very severe sovereign risk we had between 2010 and 2011, and then to avoid the risk of deflation. Having said that, we have a clear pressure on profitability. And let me share with you a paradox of the life of a CFO. I was with Bertrand in this room, he was my predecessor. In 2011, in the peak of the liquidity crisis, we were fighting for our bankers and our treasurer to collect more deposits. And now, my everyday life is to get rid of deposits. And a change of paradigm, not in 1 century, but just in 4 years. So just imagine how agile bankers have to be in those current days. Thank you very much.
Thank you. So I now turn to Manu. So Manu is founding director and chief executive officer of Centennial Asia Advisor, and is also vice president of the Economic Society of Singapore. He's very renowned for his candid views. So I trust he will be able to offer views on what is at this stage the role of the monetary policy, in particular in Singapore. In case of a negative shock, what should be the respective roles of monetary policy versus the other policies? Also taking into account the rooms for maneuver for other policies and the large current account. Manu.
Thank you. And very good afternoon, everyone. And just would like to add my note of welcome to all our French friends who have taken the trouble to come to Singapore and support this initiative. I'd like to look at 3 things from the perspective of Singapore. First, I'd like to look at the performance of the very unique monetary framework that we have. I'd like to then explain why it has been the success it has been. And thirdly, I'd like to look at it in today's context, and in particular, look at the constraints imposed on a small country by policy spillovers from the rest of the world. So just very quickly, we have a very unique framework that's based on the basket band crawl. We manage the Singapore dollar nominal effective exchange rate. The crawl is based on our expectations of or fears or concerns about inflation. There's a band which allows a degree of flexibility for that crawl. And the basket is mostly fixed and doesn't change too much. The policy framework is communicated very clearly through briefings given by the Monetary Authority of Singapore, both publicly as well as privately to economists and other stakeholders in the system. So first, how has this framework functioned? It's a very unique framework. And if you look at it, it's been in existence for more than 30 years, 30 extraordinary years where the Singapore economy developed more rapidly than China in some respects, where huge structural changes occurred. And despite this, we've gone through a whole range of shocks and crises. We had the mid-1980s recession, which is the first recession Singapore suffered in 20 years, followed very closely by a complete collapse of our stock market because of a scandal. And then we had the 1987 stock market crash, various other financial shocks, and then the Asian financial crisis, and more recently, the global financial crisis. And throughout all this monetary framework has helped Singapore negotiate its way through such an extraordinarily turbulent period, and it has come through fairly effectively. So it is a tried and tested framework. It has worked, broadly speaking, quite well. So the second question is, why has it been successful? And I think it's been successful because it is flexible. Of course, the band allows you, the band can be widened during periods of extraordinary volatility, so there's a degree of flexibility built into the framework itself. But more importantly, this framework is implemented very pragmatically, not dogmatically. It is combined with other policies on the fiscal side as well as the macro-prudential side. If we take an example as a case study of how we responded to the Asian financial crisis or even the global financial crisis, I think Singapore recognizes that we are very vulnerable. If you are plugged into the global economy and you're not North Korea, you are going to be hit by shocks every now and then. The question is not avoiding vulnerability. The question is to ensure resilience so that you have the capacity to bounce back from the inevitable shocks that will come. And that resilience is a function of having more shock absorbers than shock amplifiers. So a lot of work has to be done before any crisis happens in ensuring this. And one way we do that, because one of the most critical elements of resilience that we have found is financial strength, and in particular, the balance sheet of critical economic agents such as banks and large corporates. So financial supervision is actually a very important part of ensuring that, and that's the role of the central bank as well. So we cannot look at just the monetary policy framework itself. We've got to look at all the supporting elements of policy as well. Secondly, we have to make sure that there are no shock amplifiers during a particularly severe crisis. And quite often the shock amplifier comes through when small, medium-sized enterprises, which are major employers, do not get funding because they are seen as risky, and in a financial stress period, they tend to be deprived of funding. So one of the things that Singapore did during the financial crisis was a risk-sharing scheme under which the government undertook to take 50% of the risk of lending to the riskier parts of the economy, i.e. small, medium-sized enterprises. And I can say, as someone involved in the work of some of the financial institutions, that this worked quite effectively. So we didn't amplify the shock, we managed to absorb the shock. So I think this kind of pragmatism and flexibility helps a lot. Thirdly, in the current economic situation where growth domestically has been lackluster, due not just to weak global demand, but also because of the unavoidable economic restructuring that Singapore is going through, we've also had to deal with global liquidity. And there are constraints on what we can do as a result. The fact of the matter is that very small countries like Singapore have to accept that in this world there are very large, systemically important central banks who will pursue policies selfishly. And you don't blame them because that is their mandate. And so they will implement policies that they consider optimal for themselves, for their individual countries, but which may not be optimal for the world economy, particularly very exposed and very vulnerable small economies. So we've got to deal with these massive flows of capital. And as the Deputy Prime Minister pointed out, for a number of reasons, today we have outsized responses to what should be very small developments. And that's partly a function of the way the financial system is now structured. So our response has been to use a whole load of macro-prudential regulations, which we have been expanding and developing over time. And this has helped to reduce the impact of asset bubbles and so on. But even macro-prudential regulations have their limits. For instance, about 10 days ago, the Hong Kong authorities, tired of Chinese liquidity pouring to their asset markets and making housing unaffordable to Hong Kong citizens, imposed restrictions on Chinese money flowing into real estate in Hong Kong. Now, we've been having such restrictions for some time, and it's coming to a point where maybe Singapore should be considering easing the macroprudential restrictions that we placed on housing. But if Hong Kong has placed those restrictions and we loosen our restrictions, a tidal wave of Chinese money is going to come into our markets and completely distort our economy. So we have a major constraint there. And that's just the reality of the situation we have to face. In an ideal world, the systemically important central banks would agree to subject themselves to constraints so that they have to take into account the spillover effects of their policies on other countries. But the political reality is that this is not going to happen. So at the end of the day, small countries like Singapore have to evolve their own policy responses. In Singapore's case, I think it's fair to say that the monetary policy framework that we have adopted and implemented flexibly and pragmatically has worked for us, but we need to probably continue developing other tools, macroprudential and fiscal as well. Thank you very much.
Thank you, Manu. Unless there is a willingness for some members of the panel to ask questions to the others, I will turn to the room. Oh, yes, Olivier.
A question to Manu and possibly also to Edward. You made a good case that the currency regime in Singapore has been very effective. So, based on this experience, what would be your recommendation for China? Because China has moved also to a kind of soft peg to a basket of currencies. So I know that China is very different, of course, from Singapore, but what lessons do you draw for the very first months of this experience, and how do you see the future of this currency regime?
Looks like I will take it. It's not clear. Okay, one of the things we would like to see in a monetary policy framework is clear communication. And it is not clear what the People's Bank of China is really targeting. In our case, we make it clear. We specify every 6 months what the slope is, and whether we've changed the width of the band and so on. In China's case, if you look at the exchange rate movements of the last year or so, the real effective exchange rate has depreciated significantly year to date by more than 6%. That's a fairly significant change in competitiveness. So it's not like they are targeting a flat exchange rate in broad terms at all. And it's not clear whether that is ideal for the rest of the world currently. The question in China also is what's the range of options that they have? They've used monetary policy aggressively. However, the effectiveness of monetary policy is clearly compromised now because every time they ease, the bubbles form with ever greater speed and viciousness, and then they have to pull back. So monetary policy is constrained. Fiscal policy is being employed, but they seem hesitant to employ it much more aggressively, partly because they know that they have to build up large savings for a rapidly aging society. So although they have the wherewithal, they have this consideration and this constraint. So that leaves another option, which is the currency. And there is a suspicion in financial markets that they would like to bring about a much sharper rate of depreciation than people expect. And that is, I think, leading to a lot of instability. And especially today, we've seen very significant movements in Asian currency. So Chinese policy has become a source of volatility, uncertainty, and turbulence for the rest of us. Thank you.
Thank you. I enjoyed the session. 2 questions. One on the European side and one for the Singapore side. In the case of, so the issue about criticisms of the Fed or the ECB about being over easy, I think one has to be careful in the sense of, it's not so much a criticisms about what they did initially, it's about whether it's past its use by date, right? And so you can be very positive that it was important for them to do what they did earlier on, but is it going on for too long? So now the question is, what is when you have ultra loose monetary policy, what is the end objective here? Is the belief that the current output growth rate is still far below potential? You can have reasonable estimates that suggest that the Eurozone is actually growing currently at its potential level. Then what exactly is the role of ultra-loose monetary policy, number one? Number two, relating it to the Singapore case. I mean, Edward brought this up. Isn't there any, yes, you can talk all you want about other policies complementary policies needing to do the heavy lifting, but isn't there a moral hazard problem here? Because you're ultra-loose, no one worries about, politicians don't worry about looser fiscal policies, no one worries as much about structural reforms, and that's Singapore has always been concerned about that moral hazard issue. They didn't state it in those many words, but I think that's one of the concerns. In the case of the Singapore policy, both for Manu and Edward, yes, 82 implemented, worked incredibly well over the last number of decades. We have always been told, and we always teach to our students, that given the small open economy, high import content, the exchange rate policy, exchange rate depreciations are not very effective in terms of stimulating exports, given the relatively low value added, high import content, but they are very effective anti-inflationary tool. And so in a general inflationary environment, very effective general appreciation. During a deflationary or downturn, we don't generally use depreciation. Yes, at most we'll say no further upward crawl, we'll stand pat as we are doing now. But historically, we complemented, during a recession period, we used supply side policies as was discussed. My sense is the supply side policies aren't used as proactively nowadays. Cutting off the Central Provident Fund, employer contribution, etc. I don't think those things are going to be used as much nowadays. So what are we left with? Manu brought up fiscal policy. So is that a change? Is there a significant change in the stance of the government that we are going to use fiscal policy much more aggressively during general downturns? I mean, my sense was they were very careful about using fiscal policy only when it was really a deep downturn, then they used it. So has there been a change?
Okay, these are two sets of excellent questions. So for the euro area, I turn to Anne. And then on the Singapore side, you will need to decide whether it's the monetary authority or Manu who will argue for fiscal relaxation.
Okay, on your first point, which is the euro area growth at its potential growth level, the answer is no. So I would disagree with you. We still have a gap of at least 1%. Now, I admit it's very difficult to estimate potential growth and hence output gap, but perhaps the most important point is, what is our mandate? No, our mandate is not about closing the output gap. Our mandate is about inflation. Now, we are in a situation where inflation is slowly creeping up. If you look at the CPI, for a very simple reason, we are benefiting from the base effect of oil prices. Okay, so we expect that we would be slightly above 1% next year, which is an improvement. Now, on core inflation, we are lagging behind. We're at 0.8% only. A bit better than a few months ago, where we were at 0.5, but we're still at 0.8 only. When you look back, for the first 10 years of the euro system existence, from 1999 to 2009, on CPI we were at 1.9% on average. On core CPI, we were at 1.5. And we were, if I may say so, right on track. Now we're lagging behind. Now the question has to do with, in part, with wage behavior. And we are in a situation where we have a bit of adaptive behavior, i.e. wage negotiations are not forward-looking on a higher inflation prospect. They are more instantaneous looking or adaptive to the past record. So we looked at Philippe's curve because one important positive feature of our action has been to contribute to a reduction in unemployment. So there has been well, it's still horrendous by your standards. I mean, our unemployment rate is still at 10%. We come down from 12% on average 2 years ago. So it means 4 million jobs more. So we're slowly improving, but that doesn't translate yet in higher wage increases. So we have a puzzle there. We tried to look at the Phillips curve. We did not reach any definite conclusion on whether they had flattened or not flattened. It's very complex. We don't think there has been a significant change. We are more or less back to import prices and pass-through of the decline in import prices. We have this bifurcation between manufacturing prices and services prices. So we are pretty much in the same boat, if I may say so, than other advanced economies. But what is clear is our mandate is to aim at a stable inflation of close to or below 2%. And we are really monitoring all parameters which may have an impact on inflation to assess the proper course of our monetary policy. And output gap is not among the first consideration. The second point is about moral hazard. It's a very interesting point because you have two ways of looking at it. Either you say the governments are not doing a proper job, right? Their savings on interest expenses, and they're not reducing their primary deficit, or they're not using it for proper expenditure composition. So you should blackmail them, quote unquote, and stop being accommodative. It's a bit of a reverse beggar your neighbor policy. We have no legitimacy to do that. We have a mandate. Our duty is to fulfill our mandate. Is not, to say we won't execute our mandate because the others are not behaving properly. That we would never do. So perhaps the last remark is on moral hazard. We at least had taken precautions at the very beginning, i.e. the ECB is forbidden to finance governments directly, which means that when we deliver quantitative easing and public securities purchases, we are only on the secondary market, number one. Number two, we have limits per issuer and per issue. So we've been mindful not to be too invasive, if I may say so. So these are additional barriers to the danger you were alluding to of fiscal dominance. Hopefully one day, the Stability and Growth Pact, which is the expression in Europe to try to discipline a bit the governments, will have more teeth.
Maybe just adding a word on the euro area, just to complement what Anne said, saying that there is actually convergence between the European institutions, both the European Central Bank and the European Commission, on the fact that an additional support by fiscal policy to the current monetary policy would be welcome. Of course, it's qualified, and the qualification is that it's countries which have margins of maneuver that should be undertaking such support. But it was this opinion was articulated, as you probably saw, by the European Commission a few days ago when it publicly stated what it saw as a good fiscal stance for the euro area. But it's very much an ongoing debate, indeed. I'll turn to Edward, and then if you wish to answer the Singapore part.
Yeah, maybe I'll make 2 points, one general and then specific to circumstances post-GFC. The general point is that we do need to start with a proper diagnosis of what has caused the business cycles in Singapore and so forth. And I mean, if you do go back in Singapore's development history and so forth, the business cycles, a large part of that innovation is due to external demand conditions. So that reality check, I think, is an important starting point. False emergences of unemployment gap, of a gap in the output gap and so forth, are typically associated with a collapse in demand of our principal trading partners. And that's sort of a given world aggregate demand curve that we face. But having said that, in the context of sort of nominal rigidities within the economy and so forth, there are things that we can do to help the adjustments, the economy adjust to that shock. And in Singapore, I think that the overriding approach is to make sure that that burden of adjustment is shared among the available instruments that we have before us. So fiscal policy has a role to play, monetary policy has a role to play, and internal price devaluation or relative price adjustments also have a role to play. And all these trees have definitely played a part in previous business cycles that we face. The specific point that I wanted to make is in relation to the post-GFC period. I think what we're going through in the post-GFC period has to be interpreted in the context of an underlying drift, a structural change in trend output or trend GDP in Singapore. And that's a reflection of supply side changes in the economy, land constraints, changes in the labor force characteristics that we face and so forth. So policies in the immediate GFC period had to take those two elements into account. First, there was obviously a cyclical shock and we responded quite decisively, but we also had a lot of ongoing measures, fiscal, but also many targeted sectoral policies to deal to help that economy validate that underlying shift in Singapore's potential towards a structure that's quite different, a structure that's going to be a lot more capital intensive, taking into account and taking opportunities of digitization and so forth. And that's really a capacity building sort of exercise. And that capacity building exercise has many elements. It is a multi-year sort of project for us. And so we see that as exceedingly important as well, quite apart from the short-term policy responses that we need to make.
Just very quickly to add to that, I think on Kishan's specific point about the use of supply-side measures, for instance, in the past what we did to effect a fall in labor costs was to substantially reduce employers' contributions to our forced savings scheme for retirement. We've tried that a couple of times. However, there's a huge impact on retirement adequacy, and we've found that we already have a severe problem with retirement adequacy, and that is not a tool that should be used for macroeconomic policy. It should be reserved entirely for the retirement objective. Secondly, I think given the current predicament that we are in, which is a function of both weak global demand that Edward referred to, as well as domestic economic restructuring, I think there's a considerable role for fiscal policy, which we have not utilized sufficiently. I think some of the work we've done, we've looked at the, one of the arguments against fiscal policy is the leakages because of import demand. But what we've seen, if you look at the input-output table, is an increasing domestic content of domestic consumption. So I think fiscal policy is actually more effective now than it would have been 10, 15 years ago. So I think there's scope for a lot more fiscal policy. Finally, I think on the structural side, one of the reasons why there is a domestic adjustment is because we've lost cost competitiveness, I believe. And one of the reasons for that, I suspect, is a lack of competition policy in Singapore. We have a very, very good competition commission. I have to say that because the CEO is here. But I mean that. But by law, the Competition Act exempts huge chunks of the economy for mysterious reasons, from the enforcement of the Competition Act. And I think that is, to our detriment. I think a lot of our costs have gone up because of lack of competition, some of the key pillars of the economy. Thank you.
Thank you. I think, unfortunately, we're running out of time. So there is no huge frustration. So thank you very much to all speakers. I think that was a very rich and fruitful discussion, showing that monetary policy is effective but can't do everything. So thank you very much.